Hello, and welcome to this webinar on credit in commodities, brought to you by EnergyRisk and Enuit. It's fair to say that many commodity firms are facing something of a credit crisis at the moment. It's been a year of unprecedented volatility for many commodities. COVID-related demand shocks and the global economic slowdown have led to defaults, losses, and bankruptcies across the entire supply chain. In this webinar, we'll be looking at how firms can improve their insight into credit risk, asking what processes and procedures might need to be changed or updated, what new information is needed to carry out effective credit analysis, the differences for different commodities, and how long the current situation might last. I'm Stella Farrington, Head of Content for EnergyRisk, and I'm joined today by 4 commodities experts. So I'll introduce your panel now in no particular order. So first we have Audrey Safra, who's Head of Commodity Derivatives for APAC at BNP Paribas. Then we have Devon Chitalia, who is Senior Vice President of Risk Management and Global Head of Credit at Olam International. Then we have Simon Wu, Director of Global Commodities and Trade at the Commonwealth Bank of Australia, and Caroline Lim, who's a Senior Consultant at Enuit. So we want this webinar to be interactive. It's going to last about an hour. We invite you to ask questions at any time. There is a box on your screen where you can input your question and send it through to us, and we'll be endeavouring to answer them at the end of the webinar. So I wanted to start by giving some context to this current situation. So could I bring in Simon, first of all, Simon Wu at CBA Bank. And Simon, could I ask you, as I said, to give some context to the current situation? How challenging is it? And for example, how does it compare to the 2008-2009 credit crisis?
All right, thanks, Stella. Yeah, look, obviously over the last 6 months, it's been an incredibly volatile and stressful period for the market, for the world. Without dissecting into the two big events too much, what we saw in 2008, 2009 was like a liquidity and a financial crisis, mostly amongst financial institutions. That was as a result of, a lot of mispriced risk in the credit system. What we have now is pretty much a global pandemic, medical-induced stress to the global systems. That's totally, to borrow the term again, unprecedented. That's broken a lot of things in the world that people just could never imagine before. So what we have now is, we've got global central banks doing whatever it takes, cutting rates, injecting liquidity, swap lines, and so forth. But at the same time, we have a medical crisis that has been extremely difficult to predict the next steps and to evaluate the scenarios over the next 3, 6, 12 months and even into the years. And I think also on back of all that's been happening over the last 12 months is we've also got a backdrop of a trade war between the US, China, and we also have an oil price war that's been bubbling in the background as well for quite some time. So unfortunately, all these things just seem to happen at the same time, which created, a very large explosion, so to speak, in the global markets. I think there's a few points that we need to pay particular attention to as well, in addition to what's happened in the credit space, and that's really what happens in the real world. We've seen a lot of the supply chains broken. We've seen a lot of the just-in-time kind of model and processes broken. We've seen a lot of supply-side shocks, demand-side shocks, which will take a very long time to get back, if ever. It also exposed a lot of weaknesses in these processes, which came by after many years of tweaking. It shows that a lot of people, there's insufficient inventories, whether it's medical, whether it's commodity inventories or other kind of important materials. It's showing that a lot of these supply chains will be in place still for quite some time, but it's also very long and complex, and it can't change quickly. So, one of the other themes that's sort of popped up on back of this is probably the topic of reshoring, where people are trying to bring back manufacturing closer to consumer, closer to home base, and commodities will definitely play a big part of this. And if you also look at the impact of COVID on the market and on the consumers, on companies, there's going to be big changes to consumer household behavior, to travel behavior, to the trade relationships globally as well. So I think if you take that all into perspective versus 2008, 2009, you can see there are way more factors that people need to consider in terms of scenario modeling, risk modeling, and so forth. So we've gone from, in summary, a very financial institution credit instrument-based crisis to a very blown out global crisis that's impacted pretty much everything that we've come to know as society.
Yes, thank you. So as you say, far more things to consider this time around perhaps. And we wanted to start with asking the audience what the greatest risks are for you. So could we please put the first audience question up on the screen, please? And the question is, which of the following do you expect to pose the biggest credit risk to your firm in the coming weeks? Is it trading counterparty risk, client credit risk, supplier credit risk, stock/logistics risk, or demand destruction? So that will be interesting to find out from the audience where you are seeing your biggest credit risk coming from. And at this stage, could I please bring in Devon now, Devon from Olam, to talk about what you are seeing. Obviously, as a big agricultural commodities firm, you're facing all these issues that Simon was talking about. Could I ask you to tell us what you're seeing is the biggest credit challenge for you? And it would be good if you could comment on the answers that come in from the audience as well. Are we getting some audience answers coming in now? Yep, here we are. And it looks like client credit risk is is one of the biggest concerns there. So as well as demand destruction. So Olam, so Devon of Olam, please could I ask you to give me your thoughts on what the audience is saying and how does it chime with what you're finding at Olam?
Yeah, thanks, Stella. So I think from Olam perspective, which is a commodity player into agri space, for me, I think the credit risk, client credit risk, is a derivative of other businesses that we need to run. So as I see the client credit risk coming out to be one of the topmost rated in the audience poll. For me, I think for a physical commodity player, the demand destruction and supply interruption kind of risks are more important to watch out for. As even Simon also alluded to this from banking perspective, I would say that for us, the biggest risk is to see the health of our clients' businesses and the supply chain, the functioning of the supply chain in optimum way. So if there is demand destruction, and it's a structural demand destruction because of COVID situation in many of the commodities and many of the geographies, it is definitely going to hurt our own customer and supplier in terms of their own business cycle, and therefore it is going to put more stress on credit as well as performance risk of the company. And so I think if you really want to do a sense check about what level of riskiness you are running on credit, it is more important for you to look at the associated business risk first, which are demand destruction and supply interruption. In fact, I would just like to add a couple of other things which one can look at in this situation. Is one important risk we should be very wary of is the employee health and safety risk, because come what may, if you don't have your people or your staff on ground to execute your plans and your targets, it would not work. So I think people health and safety, especially in COVID situation, becomes the topmost risk for us to manage, and of course followed by the businesses that we discussed a lot.
Thanks, Devon. And could you comment briefly on what you're doing in terms of monitoring exposures or processes? Have you had to change much in the current environment?
Yeah, so I think for us, monitoring of client overdue or performance, etc., was normally a part of the game, but now the frequency of that and the intensity of that has increased quite a bit because we need to be really on top of what our clients are doing, and therefore discussion with clients, frequent visits wherever possible on to have a look at their operations, at least for the customer material clientele. We are doing, and we are also taking an approach where we have different way to look at things for different geographies. So for certain client subset which is into emerging market and underdeveloped markets, we need to be very careful against somebody who is sitting in US, Europe, or the first world market. While I think it is very wrong to say that you will not have default from developed markets, but I think the intensity of the level of that might be kind of beyond the threshold for that would be of a different level. So we look at from geography perspective, we look at from the client's business perspective also. So whether it's a trader, whether it's a processor, whether it's a producer, etc., because each different level would have each different type of client would have a different level of threshold for bearing the credit stress on their own books. And regular monitoring and bringing in independent mitigation at OLAM level, plus asking for certain mitigation from client, which we'll talk later, is the key for us, Stella.
Okay, thank you. Audrey, could I bring you in at this stage, please? It would be good to get a bank perspective, Audrey from BNP. How important is it to you that firms are aware of their own credit risk? Because presumably you're doing your own very in-depth analysis anyway. So does it make a difference to you if clients are carrying out some sort of credit monitoring and analysis themselves?
Yes, indeed. I mean, banks would typically do their own in-depth risk assessments, be it qualitative or quantitative. So first, it's of course our core expertise, and second, I mean, there have been increased scrutiny from regulators, especially post the 2008 or 9 crisis, for the banks to do so and then set aside the right level of reserves against the risk they are facing. So indeed, it's very important that clients understand, the type of analysis that will be conducted, on them, but also for them to duplicate it for their clients. And whilst it affects the pure credit risk, and when you extend funding or financing to a counterpart, it's easy to see the exposure that you have. But you need also to look at the nature of the exposure and to see what would be, for instance, your recovery around it. But when it comes to actual market risk-linked exposure, you need to really have systems in place and models, quantitative models, to be able to assess the potential exposure that could be derived from such exposure. So it could be to commodity prices or FX or rates. So indeed, if most of our clients, the professional ones, may have such tools or can easily get some providers to give them some all-in solutions. Otherwise, basically, I mean, of course, when we are supporting our clients, it's also our duty to help them to understand what it is. And sometimes, as part of the service, we can provide some information or even, deliver some risk scenario, quantitative reports, or daily mark-to-market reports to them, so they can, have some tools and some information to monitor it.
Yes, thank you. And now, could I bring Caroline in here, please? Caroline of Enuit. And what sort of things are you seeing clients asking for at this time? What sort of operational challenges might they be struggling with in order to gain a better insight into credit?
Hi, Stella. Currently, there are still companies that are still reliant on Excel spreadsheets to handle their risk analysis and reporting. Using Excel can be a very manual process, prone to error and even manipulation. And it actually does not provide a proper trail for the changes that were made. In current times, due to volatilities and actually tighter control needed in market, companies realize the need to systemize risk management. These companies have inquired about Inuit's N-Trade system, which actually caters to small enterprises as well as MNCs. We have out-of-the-box solution which enterprises can subscribe to. We also create bespoke solutions customized for the respective clients. N-Trade actually can integrate market risk, credit risk, as well as supply chain management solution. And on top of the entire trade life cycle, it actually provides clients complete end-to-end visibility of the entire trade value chain. And N-Trade enables clarity and transparency in clients' risk assessment, monitoring, and communication, thereby galvanizing the client's risk management process, policies, and protocols.
Okay, thank you. I'd like to turn now to perhaps sort of recognise that when we talk about commodities, it's a very big, broad spectrum of things, and there are huge differences in the way that different commodities markets operate. So I thought it's probably worth spending a few minutes here just talking about that difference, and perhaps it's becoming particularly notable now in terms of the energy sector, where that is facing its own set of perhaps more structural issues to do with transition risk and the transition to the low carbon economy, whereas for some other commodities this is perhaps more of an acute COVID-related issue. So Audrey, could I ask you here to talk about what you're seeing specifically in the fossil fuel sector? Is it more of a challenging credit situation there, and is it more of a long-lasting situation?
Yes, indeed, it's the beauty of the commodity sector to have to deal with a very diverse, asset classes. So basically, when we speak, about commodities, indeed, you can speak about energy or fossil fuel in particular, but now energy is indeed much broader than that, or metals or agricultural products. So basically, they all vary in terms of fundamentals, because when you speak about commodities as well, you really have a link to real economy and to real industrial or logistical matters at the end of the day. And they also have different financial markets patterns depending on how they are traded, where they are traded, whether the contracts are physical or pure financial products. So when we have seen, the reactions over the past few months in the various commodities asset classes, we have noticed lots of sharp moves and dislocations and unprecedented move to take the word of the vocabulary of Simon earlier. And basically, if we want to take the two extreme part of the spectrum, on one side you have energy, where we have seen a very sharp downward gap in March and the second one in April, and on the other side you have precious metals, which has reacted very differently, more on the upward side, and with also some dislocation in the market. So yeah, when we come back to energy, indeed the sector is facing many structural challenges. One is indeed energy transition urgency that has been all over the place over the past year. So it's not a brand new topic, and the trend seems to accelerate those days. So of course for BNP Paribas, it's at the core of our values, and we have been pioneers in sustainability. So our goal has been to accompany our clients along that route, but for many years now, and to try to accelerate. And for instance, we are quite leaders in green bonds emissions or carbon reduction solutions today. So the oil and gas sector is really transitioning, probably as well transforming itself with the COVID situation. So over the more short-term tenor, and given what we have seen, over the past few months, the acceleration may come as well from this situation, because the COVID situation had an immediate and very deep impact in the market. So, and this is now, but indeed we don't know how long it will last, and most probably it may actually lag for quite some time. So financially, the player in the energy sector have been impacted quite meaningfully across the board. So, for instance, consumers have faced or are facing a scissor effect now with revenues dropping, whereas basically they may have some large exposure on the financial side, and especially on the back of falling oil prices. And trading houses have seen increased physical strain and credit issues. So we have seen that the current situation has triggered immensely stressed scenarios in the industry, and in some cases, the worst case scenario have led to massive credit default that are now in the public domain. So now it's very critical for the oil and gas industry in particular and the companies to get the support from banks or from their trading partners, and to get as much advisory to address their liquidity or credit constraints, and then over the long run to be able to position themselves along the way of the energy transition, and to be able to really transfer the business model.
And just very briefly, presumably they're dealing with this at a time of constrained credit, but actually to transition is going to be an expensive business. How do you work this out as a bank?
So in terms of transitioning, I mean, of course, some corporates or companies are more advanced than others. So basically, the more advanced one have already, set some very specific sustainability goals. So be it in terms of environmental or more broadly CSR topics along the way, are monitoring them and are actually communicating around them. So for instance, if you take the largest oil and gas company, in addition to indeed communicating on the write-off and the quite substantial write-off they are doing on their pure fossil fuel asset classes, in the meantime, they also start to look at those sustainability topics and have started to transition towards either green energy or other initiatives, and to put some goals in place for instance, carbon reduction scheme with a fairly long outlook, because indeed, it won't be tomorrow. You cannot transition for a variety of reasons overnight from one energy systems to another, but still they are setting goals and more aggressively towards the future. And for the late entrants, I would say, of course, we are always there to advise them. We are, as I just mentioned, quite leaders in the field, and basically we are available, and we have dedicated teams to answer the questions to the client and to help them to put in place some criteria, so be it in their own financing, bond issuances, or even now in derivatives contract, to step by step actually transform themselves in various ways across their businesses.
Okay, thank you, Audrey. Sticking with the topic of the differences in commodities, could I bring Devon in now again? And could you talk about the different approaches Olam takes to credit for different commodities?
Yeah, thanks, Stella. So I think I've heard carefully whatever points Audrey made just now. And I would like to just bring in a bit of a different perspective for a commodity player, especially in a sector like agri, and companies like Olam. So first of all, unlike bank, we are not into business of credit, and our credit is much more operational, and we are actually compelled to give credit to our customers to cater to our business objectives. So that's a basic difference between the way bank operate and the way we see credit, and therefore we cannot possibly start our credit evaluation based on availability of balance sheet from our customers and suppliers. Because if we do that, then it's a major no-go for most of our counterparties. So just to give an example, in an agri industry where Olam operates, which is much more scattered with lesser number of corporate customers base that way, customer and supplier base, 80-85% of the clientele don't provide you any of the financial backup, and you have to largely then rely on a lot of subjectivity and there is definitely a method to madness in this, and you can actually triangulate a lot of creditworthiness related data points through many other things, like like the reputation of the customer supply in the market, how big his operation size is, what type of business he is doing, and what type of business model he is into, what is the feedback that you're getting from banks for the customer from local, whether it's a local player or regional player, and what is the most importantly, what is the feel of your own team on the ground by interaction and visits to the client. So all this gives us a lot of insights. And then we also look at what level of exposure the client can take with Olam and what is our target size, and then we decide on our exposure limits on credit and forward contract. So that becomes a very important, and I'm sure that each industry in some form and manner looks at the credit in this way, because let's say I talk about energy industry. Energy industry has much more matured clientele with reasonable or solid balance sheets, and therefore there is a good amount of analysis that one can do to start with in terms of deciding how much exposure we can have. But when I compare it with agri, so each industry would have its own nuances, and each industry or each commodity based on volatility. I think somebody dropped off. Or hello, can you hear me? Ella, can you hear me?
We can still hear you, yes.
Okay, I think somebody has put us on hold, that's why. Okay, so just to conclude, should I continue, Stella, or should I wait?
Yeah, no, please continue. We're not sure what the technical issue is, but do plow on.
Yeah, so I think just to conclude, I think it is very important for us to look at the different commodity in this manner, and the related the credit I would say risk for that matter. I think Stella, so you need to ask someone to kind of come back.
Thank you, Devon. It sounds like there's a mobile phone going off somewhere, but we're not sure where that is. So, well, if I could now, this might be a good time to cut to the our second audience question. Could we get that question up on the screen now, please? And the question is, what is the biggest challenge you encounter when assessing your company's credit risk? So in our earlier question, we asked about what you see as your biggest credit risk, and now we're looking at actually tackling this. What's some of the biggest challenges you encounter when you're trying to tackle credit risk? So could we get that question up on the screen now, please? And as I said, the question is, what's the biggest challenge you encounter when assessing your company's credit risk? And the answers are either getting accurate data on counterparties and clients, or understanding your bank's credit assessment and appetite, pulling together information from siloed risk systems, and this is before analysis can even start, or developing analytics to assess credit risk. So this will be really interesting for us to find out where people are on that journey and what they're finding, the biggest hurdles to assessing their credit risk. And I think here, could I bring Caroline in first, please? And it would be good to just get your thoughts on the answers to this question as they come in. We can see what are the biggest challenges that people are tackling, and you could talk about whether they chime with what you're seeing, the inquiries you're getting from clients. So are we starting to get answers coming into that question now on the biggest challenges around credit risk? And Caroline, yes, here we are. or it looks like rather overwhelmingly, people are struggling with getting the accurate data on counterparties to start with. So, Caroline, could I ask you, does this chime with what you're seeing?
Yes, because there's actually a time lag between the data that is provided outside versus what is actually happening on the ground. So, due to this factor, it can get a bit challenging getting accurate data regarding counterparties and clients. But what we can control is actually internal data that we can collate. The clients can collate, and this is what our trade system actually can assist. And we have also seen companies where they actually use multiple systems to handle their risk assessment. But what is unique about our Entrade Unite is that we can actually support every commodity across different commodity sector. We have features where every users can actually collate the data in one place on one single platform. And our clients actually include specialists in the agri, the metals, the power, and the oil and gas. So this is a unique feature of our system. And we have the ability to actually handle not just across the commodities, but to track the entire life cycle of international commodity trades and support clients' entire front to back business function.
Okay, thank you.
That's all. Yeah.
Devon, could I bring you back in here, please, Devon?
Yeah.
And could I ask you to comment on those audience findings, and does that chime with what you're seeing as a commodity firm?
Yeah. So actually, if you really see, what I was alluding to, it is something which is resonating with the audience as well. Getting the accurate data from counterparty and customer or clients is definitely a challenge. Even bank faces that, and even commodities firm faces that. But both have different purpose and value of this data point. But as I said, for commodity players, it is very important for us to still continue doing business with them, and that we need to find a way on how to really assess the creditworthiness, how to put up that kind of probability of default or those parameters. And for us, frankly, these are just indicators. So I would, as a commodity risk manager, I would really go into A, geography, B, client business type, C, past performance record, D, what kind of tenor, or the operational tenor I'm approving. Is it 6 days, 10 days, 30 days maximum for supply chain, and what kind of operation size the client has. So all those parameters gives us a lot of insights into what kind of exposure we ideally should be running. So I think that is something which is even coming out from the poll, and is a very important element. Because as we know, we will never find the 100% data to act or decide on our business decisions.
Yes, exactly. Okay, thank you. Simon, could I bring you in here, please? And we'll move on slightly from the sort of insight and getting data for, the challenges around getting the correct and accurate data you need. Perhaps you could talk on that briefly, but also move on to what some of the risk mitigation and transfer techniques that are available for commodity companies in these situations.
Yep, sure. Thanks. Look, touching briefly on the point about the getting the data. I think first and foremost, even outside of times of crisis, there should always be a very honest and transparent conversation between two parties regarding how the business is going and how the plans are. And I think being an optimist, one of the things of this crisis is that it's a real ability for firms to really test out whether their policies and risk frameworks are actually effective, or are they just simply words on pieces of paper. So the audience has made it clear that this information gap is definitely a big block. And when we sit down with a client, we're going to have very different conversations if we're speaking with an airline versus a steel mill versus a refinery. There's a lot of industry sector specific questions and situations, and at the same time there's a lot of finer things that we need to take into consideration when we try and work on a solution with the client regarding whether it's loans or derivatives, and any other things they may need in terms of how to keep the business going, right? And Devin mentioned this earlier as well. There's also a big social side of things now that probably wasn't considered once again back in the financial crisis. There's been a much bigger push here now in terms of people's welfare and being, and we're even reading things now that big companies especially are asking, is there a role for a chief medical officer in the business to look after not only people's health and well-being, but general medical situations going forward. But with that being said, we feel that there's obviously a lot of opportunities as well in the risk mitigation, and I would call it an opportunity for both the client and for banks and for traders as well to look at these things. So, for longest time, one of the biggest tools has been insurance in terms of how people look at specific risk, whether it's sector or name specific. But I think over the last couple of years, and especially with my time spent in the structured credit space, there's definitely an opportunity to bring in a lot of other different kind of investor profiles who want exposure to these risks, to these sectors, and they just use slightly different instruments in terms of how they look at it and how they want to participate. Whether it's funded, unfunded, whether they want levered or unlevered. But essentially, what we do in banks is we're trying to match up the risk profiles between investors, between the bank itself, and between the clients. So there's lots of instruments out there, and it's once again, it's like going to a mall. Right? You're not going to buy everything, but you need to know what you can buy and why you're buying it, because it might match your risk profile, it might match your investment mandate, and so forth. And I think also even leading up to the crisis, there was already a big trend moving towards what we see in the market with these trade finance funds, with these supply chain financing funds that have been popping up, and they can be sector agnostic, or they can be very specialized. So they can be very focused on the agri sector, they can be very focused on the energy sector, they can even be very focused on very niche things like the textile. So there's a place for everyone in this market, and what's interesting is that even with technology as well, it's opening up things even more. So the concept of tokenization and distributed ledger technology, it's opening up different ways for people to syndicate risk, to get different people to participate in risk. There are even guys out there who try to sell receivables to retail guys. It's like starting from $1,000, you can participate in receivables financing. So that is probably on a lot more micro scale, but I think it more broadly is just about what are the options out there and what is the appetite out there from different market participants to get exposure to commodities risk, whether it's price risk or performance risk, and so forth. So I think there's a lot of interesting opportunities out there.
Okay, thank you, Simon. And finally, it would be good to just get a sense of how long people expect this situation to continue. And as we've talked, as we've mentioned, it's different according to commodity. But could I bring Audrey in here? And very briefly, Audrey, could you give us your sense of how long you think people perhaps need to hunker down for?
This is a quite very important question. So at the end of the day, I think the uncertainty surrounding the current situation is still extremely huge, and we remain the case for probably over the short to medium term. So we say the next 12
18 months that this will be the case. It might be the case that at some point the situation will regularize, but I would say that it will be around a new normal, so very different way of doing the main flows. It's probably less on a global scale, but more at a regional scale. In some respects, as globalization has shown its limit, and in terms of market, there may be some linkage to this as companies if the COVID situation is not addressed in the near term. So despite the current euphoria and lots of liquidity that has been injected around the globe by banks, it's difficult to see a very
Audrey, we're losing you a little bit here. Is it possible to speak up a bit?
Yeah.
Speak a bit loudly.
Sorry. Yeah.
That's much better.
All right, sorry. I would say I was just saying that at some point, we would see probably some regularization, or at least people will come to a new normal. And since globalization may have shown some limits, it's probable that things will regularize, but on a more local or regional scale. But I think the uncertainty is still very high, and we will have to monitor over the next months to see what's coming up.
Thank you. Okay, so that's reached the end of the first part of the webinar, the panel discussion. I'm now going to pass you over to our sponsor, Enuit, who's represented here by Caroline Lim, and she's going to speak for a few minutes about Enuit's business. And then after that, we're going to come back to the panel again, and I'm going to put some of the questions that have come in to the various panelists. So for now, I'll pass you over to Caroline.
Hi. Okay. I'll talk a bit about our system, especially on the credit utilization component, where our system is able to actually track your credit utilization, entire life cycle of your letter of credit, collaterals, and margins. Next slide. Sorry, next slide. Yeah. This slide shows the relationship, the interlink between market and credit risk, and thus having an integrated CTRM that can support multiple commodities and provide complete trade life cycle and trade value chain visibility will enable a more holistic risk management and assessment. Next slide. Typically, for credit risk setup, we need to know what to measure for credit risk. What are credit risk limits, when to check for credit risk, how to check credit breaches, how to check credit details, the credit logic, etc. Next slide. This slide shows our N-Trade system where credit bucket types are configured. Credit bucket type form actually sets what to measure. For example, the inventory, storage, LOI exposure, margin. All this can be set up within this form. Next slide. This slide shows the credit entity form where credit limit values are allocated to the respective credit bucket type of the entities. Next slide. This slide shows the counterparty form where credit management instruction can be set. For example, when to perform credit checks, when the system should pop warning and alerts. All this can be configured within our system itself. Next slide. This form shows the credit exposure by counterparties. The exposure can be sorted by different credit bucket type. In the example given, Company 4 is showing open credit utilization, which is below the net open credit limit. Hence, it is okay to trade with company 4, whereas company 7 is showing potential open credit utilization, which is beyond the net open credit limit. Hence, it is not okay to trade with company 7. Yeah. Next slide. Okay, to check the details of credit breaches, users can actually click on the respective value and it will drill down to the details of the trade itself. Next slide. This slide shows the end-trade credit management cycle. It starts off with the usual onboarding of client, the credit assessment, the setting of limit, and thereafter trade approvals when trades are done, exposure management, and portfolio management and analytics before the offboarding. Next slide. This slide shows the functional coverage of N-Trade Unite, which is across commodities. It actually shows the entire trade. It actually covers the entire trade life cycle and end-to-end across the entire trade value chain. Next slide. This is our contact, Singapore's contact. So if there are any inquiries, you may email us or give us a call. Thank you, Stella.
Okay, thank you for that, Caroline. And now we're going to turn to some of the questions that have come in from the audience. Thank you for sending those in. And the first one came in from Sylvia Lim of Hengli Petrochemical. And this is an interesting question. With banks tightening risk appetite, how do firms continue to assess credit risk of counterparts? It will ultimately rely on banks' clearance, even though companies do their own assessment. So I wonder, could I ask Devon to comment on this first of all? I mean, is this something that you feel, you could do the best credit analysis there is, but at the end of the day, the decision is actually taken by the bank?
So the question is, can you just, sorry, I missed the first part. Can you repeat me the question?
So she's asked, with banks tightening their risk appetite, how do firms continue to assess their credit risk on counterparties? Because
so I think,
the banks.
Understood. So basically, we are, as we speak, we are facing this issue right now because, earlier banks and even credit insurance companies have had a high appetite for the customers we are dealing with, but naturally with this COVID situation, etc., their appetite itself is coming down, and rightfully so in a way. But we can't stop business with clients. We have our committed contracts with them. We really need to kind of honor that, and we even need to continue doing business for future, and therefore the kind of mitigation we look at are a bit different. So we of course, we still try to continue to find support from external agencies like credit insurance and all. We also look at, if we are dealing with some subsidiary of a group, we look at, can we have a corporate guarantee from the parent company? We also look at, can we have some kind of collateral coming from customers, and can we work on different payment terms, let's say either stricter payment term or certain part of the business without credit and certain part with credit, etc. And can we look into, deferring the shipments and, kind of evenly distributing it to ensure that the peak exposures are within appetite. So those kind of things we definitely do quite a lot. There is no one answer to all the questions here, and we really need to kind of see what particular geography, what level of customer or supplier we are talking about, and accordingly we define our strategy. But it's a dynamic thing we really need to review. as we progress, and we also need to monitor the performance on these exposures. That becomes very important. And if you see any laxity in terms of payment cycle and all, we really need to clamp down on our exposures in that particular area of businesses.
Okay, thank you. There's another question come in from Chuan Chi Lo at the Bank of Singapore. And it is, there's been massive interventions by central banks globally. How concerned should risk managers be when faced with the assessment of credit risks for zombie companies and the longer term moral hazard issue? So would anyone like to attempt to answer that question?
Hi,
Simon, perhaps.
Simon here. Yeah, I'm happy to take this one. Yeah, look, I think obviously there's a whole subset of answers to these questions, but to keep it brief, when you look at the credit risk of these perceived zombie companies, I think there's a few key things. Firstly, is what is the implicit state support for these companies? So it's very different when you look at things like in Asia versus companies in Europe and US. Because there's still a lot of very much so state-backed kind of companies in Asia that are also partially listed. So we've seen through this credit crisis some of the companies that have seen implied state support come through, and we've seen some that probably haven't. So that's one key thing. So it goes to show that it can be a real test of what this implied state support is. Now, taking a step back and looking at ones that don't have that backing and purely publicly listed companies, well, a lot of times you might look at the share price and that can already tell you a lot of the story, right? To borrow from efficient markets, you've got a lot of smart people in the market doing their homework and looking at these things and trying to price this already. You can look at credit spreads for these names. You can look at how the stock price is performing, and that already tells you a lot. And how you should be looking at it is you should be looking at this in addition to the own homework that you are doing, because I think if you look at the scenarios of how these things can play out, what is the likelihood of central banks pulling this cheap funding in the next 3 to 6 months? You assign a probability to that, which is probably extremely low, and then you figure out how this impacts the broader business of these companies you're looking at, and then you take the next step and look at, well, what's its actual strategy? How's it going to survive in the new normal? And then I think you also have to appreciate what is, once again, the more social side of things. What kind of role do these companies play, right? Like if you look at a SOE kind of name out of China, even if they're losing money, it's very likely they'll still receive support. The level of support can be questioned, but it's very highly, it's a very high chance they'll still receive the support. Now you look at that compared to, that same kind of industry, same kind of name, same kind of size company in the States, and it might be a very different thing, right? They might look at the bankruptcy proceedings and the process, how many jobs will be impacted and so forth in a very different kind of lens. So, to look at a zombie company, I think it's more than just the financing angle. You got to look at a lot of other factors to think about what that credit risk is for that company. The longer term moral hazard, well, that question I think is still being asked, trying to answer for the 2008-2009 financial crisis. So it's not one that's going to give anyone a satisfactory answer. I think once again it goes back to people to be able to do their homework, to pick the right counterparties, to pick the right sort of transactions they want to do, and I think the structure of transactions is also very important. But with how the whole world is being turned upside down, you need to have a pretty broad view on the scenarios that can play out and plan accordingly.
Okay, thank you, Simon. We've got 2 more questions that we will hopefully get time for. The first one comes in from Cosmo at the HKMA, and they've asked, what are the risks facing the oil exploration and production industry in the US in light of depressed economy if oil prices continue to be depressed, what would the strategies that these companies what would be the strategies that these companies could possibly follow to weather the crisis? Audrey, could I bring you in here? And obviously this could be an entire seminar on its own, but could you perhaps stick with the shale industry, who's facing the worst credit crisis in the US, and just talk about generally how you think that will how they will weather this crisis.
Generally speaking, it's very specific to the US, and overall, as we discussed before, the oil and gas industry, and especially for the upstream side, will be under strain because of the sharp change in the supply-demand balance that we have seen over the past few months. So the demand side globally is fairly depressed, is meant to be, for quite some time. So not only for the U.S. producer, which still, have grown their production quite substantially over the past 6 to 7 years, but it affects all the others and the OPEC plus. So we have seen, whatever decision is taken, during the OPEC meetings, is having a huge impact on the oil price, and the demand side remain extremely weak. So globally speaking, there has been already some cuts that have been agreed in such meetings, and going forward, if the demand side remain as depressed as it is today, and there are many factors that may support this trend on the demand side, because the borders are not necessarily reopening, the uncertainty around COVID is still there, so the traffic, the airline traffic, is not picking up anytime soon, and even locally, the movement of crowds is still fairly depressed. So it will affect globally the industry, and most probably the US also in particular, because they were also exporting to a large extent. This being said, in the US, I'm not extremely wary of all the details, but the political landscape also matters. So you have also the elections, in the US coming up, and some environmental as well challenges that industry will have to face. So basically, as far as companies which are extremely weighted against that business only, they may remain under strain for the foreseeable future, I would say.
Yes, okay, thank you, Audrey. And for more details on that, we actually ran a sort of sister webinar last week which focused on the US. So that's probably available to listen through as well, to get some more information on there for you, Cosmo, and thank you for that question. So let's turn to our last question now, and we just have a couple of minutes left. And the question is, are companies instituting new processes or procedures around credit monitoring because of recent events? And could I put that to you, Caroline, for your sort of broad view of across lots of different companies? What are you seeing there?
What we are seeing is that there are actually many enterprises moving from, as mentioned earlier, the manual process to a systemized risk management process, and what actually that actually is something positive which comes up from this so-called crisis, and it also is a period of time where the company actually do internal self-evaluation in terms of their risk management policy, their risk management process, and integrate the BCP into the entirety of the whole risk management process as well. And I can't emphasize more the benefits which an integrated risk management system can provide. So as mentioned again, the same tagline across commodities, covering the entire trade life cycle and end-to-end across the entire trade value chain. And this would allow clarity for the company to view their exposure across the different commodities, the different business units, the different departments, and galvanizing their policy protocols and processes. Yeah. Thank you, Stella.
Okay, thank you very much, Caroline. Thank you. So that's about all we have time for today. So it just remains for me to thank our panelists, Caroline Lim, Devon Chitalia, Audrey Safra, and Simon Wu. Thank you so much for taking your time to share your insights with us today. I'm sure everyone found it very useful. And thank you to everyone for listening.
Thank you.
Thank you.
Thank you. Thank you, Stella.